We're joined by John Stoltzfus. He's Chief Investment Strategist and Managing Director at Oppenheimer Asset Management. Always good to see you, John. How are you, sir?
Doing good, Mark. Nice to be on the show with you. Thanks for having me.
Yeah, great to see you. Now, I understand that you think that that little downturn we saw in the SP 500 and U.S. stocks in general earlier in the week, that was just a little haircut, a little trim, and a pause that refreshes. So why are you convinced of that?
Well, what convinces me really, it has to do with the economic data, whether it's the inflation data, whether it's the jobs numbers, whether it is the resilience seen in retail spending in terms of the consumer, and then earnings, revenue and earnings growth. It really looks like, if anything, it's a matter of bears and skeptics getting to the point where they realize that it is indeed the end of free money because the economy is doing well. The Federal Reserve is likely to do limited cuts this year, if any, but that's not a bad thing. You've got an environment where, at long last, bond issuers are once again paying for the privilege of borrowing money, and bond buyers are getting something in return in terms of a coupon, which is a fairly important thing from a historical perspective. During emergency periods, great financial crisis, pandemic, of course, that disappeared, and we were in an overstimulation had to be put in to keep us from going into a recession or perhaps even a depression in those cases. But now the economy is on a path of normalization. And once you get a little bit more acceptance from the skeptics here, likely we'll be able to continue to see this broadening of the rally across the style, across sectors, and across market capitalizations.
Now, John, still with U.S. Treasury yields, they have been moving up, as you said, but you see it as normalization. And so are you saying that bonds can now be complementary to stocks where they haven't been really for the last couple of years? So a 60-40 portfolio could work now?
Well, in our view, as market strategists, we would suggest that people consider a little bit lighter than 40 in fixed income due to the volatility that we see now and the potential for stocks to move higher, and even a broader array of stocks than just one sector. So what we think here is, complementary. We don't think bonds are competitive. There are people within the market. I think most of them reside in the bond market. I think 5% coupons are competitive with stocks. But just think of all those people who in 2023, in the fall of 2023, October, I think, was the high for the 5-year Treasury yield, then just opted for a 5-year Treasury, and missed what happened in 24 in terms of the S&P 500, up some 23%. And bonds didn't have that good a year last year. So we think for diversification purposes, if you're an intermediate or long-term investor, you want to own both stocks and bonds, be diversified across sectors, but we prefer cyclicals over defensives. We think the economy is moving towards a sustainable pace, aided by a Federal Reserve that is very sensitive here on both parts of its mandate in terms of keeping an eye on inflation, working to bring it down, but at the same time very conscious that they have to be careful that they don't have too much of a restrictive policy because they don't want the unemployment numbers to jump to levels that are higher than between 3% and 4%.
John, back to the U.S. economy, you talked about its resiliency. Do you think a lot of that has to do with the relentless innovation, which really seems to be ramping up now more so than usual, obviously because of AI, but is that a big part of it?
We would think so, Mark, but we would say it is one of the players of it, if anything. Most certainly within the market, it's been a key driver within the technology space and the whole story of data centers and moving towards more alternative energy and all these different things. But we would have to say that it's not all of it. but most certainly innovation is playing a role. And AI, we see, is not only benefiting tech and communication services, but in effect have the potential to benefit all 11 sectors, including those sectors that are not they're not creators of technology, but are get the benefit of technology if they invest in it. And we're seeing a lot of companies investing in gradually into AI, and the big tech companies, of course, are doing major investments. But the idea is to keep your competitive edge, gain a competitive edge, or just keep a good value argument for investors to be loyal to your stock and for your business to be profitable.
We saw the CPI number out of the U.S. This week. It did accelerate month over month to 2.9%. It was 2.4 back in September. So you've got that going on. And you think inflation will remain fairly sticky. I like to look at the 3 C's: coffee, cocoa, corn. Those are all going up. So, and people are paying something like maybe 20, 21% more than they were even 3 years ago in the U.S. So what's your view on inflation, and does that put the Fed in a box? How many more cuts this year, if any?
We think that in this year, we're looking for 2 cuts, probably one at mid-year and one at the end of the year, and that is only if warranted. We don't think they have to raise in this environment. And the stickiness of the inflation, we believe, is quite normal. You know, I've been in this business for 42 years. So when I came into this business, and I know I've mentioned this to you before, Paul Volcker was in his 2nd term. So I can remember when inflation was so high in the U.S., in the early 80s, when the 10-year yield actually neared 16%. It was a very different interest rate regime, and it was higher inflation than we'd seen in many years. But this round, our cap was 9.3. We're down to this 3.3, 3.5. And if you look at some of the gauges that the economists look at, you can even bring it down to around 2.8. But still away from their 2% target, which I think is a little bit optimistic. I think as the world invests in more businesses, the infrastructure here in the U.S., chip plants and all, it's going to put a demand on skilled labor, and all kinds of labor for that matter, a variety of things, also materials to build plants and to design equipment. There's a lot ahead, but we're not looking for a Fed that is asleep at the wheel, but one that is rather very, very experienced and in dealing with inflation and keeping a lid on it.
All right, John. Well, thanks as always. Have a great weekend.